Hello everybody, I'm Itaba Elliott here. I just wanted to make a quick video for you as a follow-up from my economic collapse video that I made last year. It's gotten quite a few views, and I admit I definitely was wrong about it. I was predicting that there would be a crash right here. There was a triple top formation, and it actually broke way out of the triple top, which is historically significant. Resistance at the top here should have bounced down at least and should have come down from resistance and then gone through, but it just blasted all the way through. And I want to show you why this has happened and what this actually means, and to prove to you that this is actually a false breakout. It's a manipulated breakout. And I want to show you a few things also. This page here, really interesting. This is a picture of the Dow Jones Industrial Average from 2012 to current, and it mirrors virtually the exact same pattern that we saw from 1928 to 1929 before the huge crash. And I want to show you what this is right here. This is a head and shoulders pattern in the Dow Jones Industrial Average right here in the black line. And once it broke the shoulder here, this is the one shoulder and this is the other shoulder. The head, shoulder, head, shoulder. Once it broke the other shoulder, you had a precipitous downward trend. Quick losses and huge volume. So what we have here is we also have a shoulder. We also have a head. And now right now we're building the other shoulder. And so I want to tell you, if the stocks come down to this level again, and if it breaks this level, you're probably going to see a huge precipitous drop. Now, you might see some support in here, though, because there is previous support in this area. But if you see any kind of breakdown below this area here, you're going to see a drop at least down to these former support levels, resistance levels. Once they broke above, you can see they come down and they kind of test. So you'll see at least a drop down here, at least down to the 1300 level. And I want to show you a few other things. So this is a really shocking look at virtually identical chart pattern from now to compared with the 1928-29 stock charts. So this could be very dangerous. This is a similar thing they did before the 1929 crash. Hyperinflated the market and then popped it at will, and while all the investors lose all their money. And so I just want to show you a couple of other things here. This is the previous. This is kind of like the chart I was showing before. We should have had, this is huge historical resistance. We should have had a test here and then come down below, but this broke, it just totally obliterated it, broke way above. And if I drew a Fibonacci line from here to here, we're probably coming close to about 33%, which is often a resistance level. So what we're going to see for sure is at some point, probably soon, we're going to see these stock levels come down and test the former resistance, which is now going to be support. And it's going to come down for sure, guaranteed, to these levels. And I want to show you why that is on the previous page here. Sorry if my filming's not good. I'm just holding my camera. So these red lines, I've pointed out all the peaks from approximately 2011 to the current time. Now, these red lines are all the peaks, and if you see here, I've drawn a trend line from the lowest peak to the highest peak. And you can see, I'm not sure if you can tell, but it's definitely a downward trend in liquidity, and yet we're still having higher highs. So that means that it's losing steam. Even though the stock markets are actually going up, it's really losing steam because less and less investors are driving it up. So it's just this kind of maniacal insanity driving up the stock markets. And I would say that they're purposely manipulating it so that they can get as many investors to buy, so that when they actually start shorting and selling put options, that they make their money on the way down, because this is what they do. is they manipulate the markets, they give it an artificial boost, put out fake artificial economic data, while the markets are being artificially stimulated by the Federal Reserve and in other ways, and putting out false economic data. And I'll show you something right here. Here's a report. It says, under President Obama, U.S. exports have been increased by 50%. So this is what they say. They say, oh, the exports have increased by 50%, but the fact is they grew by 0. Because what they do is, so there was the crash in 2008, and then they say, well, from the bottom, there's been a huge 50% increase in exports. The stock market's doing amazing from the bottom, sure, but if you don't measure the whole historical picture, which they're not doing here, then what we got is we have false economic data that, unfortunately most traders and most citizens don't take the time to look into and see what the actual truth is about it, and realize that it's actually just propaganda to prop up the markets. And so I want to show you one more page here before I shut it down, just to kind of reinforce the idea that the fact that resistance levels do mean something. Here we go. So we had a run up in the markets and then drop back down. You can see it's right at the old resistance support levels here, support levels here, support levels here. And so it takes off, comes back down, just touches the support level, but really the new support level is actually here. Comes up and it's grabbing all the it's dropping down, testing support, and then coming all the way up here, just as we saw here, a huge drop, and then right back up to resistance, drop back down to support. We should have seen, because this is such a historical significance, we should have seen a drop back down, but they artificially manipulated the stock markets, and now it's come on up, and I bet you're going to see about 33% from the bottom, from the lows. I don't have the Fibonacci tools up right now, but I bet you're going to see about a 33%, and then it's going to come back down to test these levels. So don't get caught in the market. Don't get caught in this market euphoria, these false economic reports. It probably will go up a little bit higher, but you're going to see it's definitely going to test these levels. It has to. This is huge, historical, significant. Now it's going to be support, and then if it does break below here, you're gonna see it resume this pattern. This is probably, in my opinion, this is artificially stimulated. This is a fake bubble. They're popping it up, like I said before in my other video. They're going to falsely pop it up. In my opinion, they've manipulated the public. They're doing quantitative easing, just devaluing the U.S. dollar. The trade deficit is still going up, even though they put out false reports saying it's going down. And so there's no real economic recovery, and we see yet historically high stock market levels based on what? When it's really not the American companies doing well. It's companies like Toyota, who are foreign companies doing well, operating in the U.S. And so we also have the Chinese currency peg. Anytime China wants to drop the currency peg, as soon as they do that, the U.S. dollar is going to plummet. We also have BRICS. We have Brazil, Russia, India, and China all getting ready and already doing it, dropping the petrodollar, and they're going to start trading oil and other currencies. And once the world catches on, and once the world decides and realizes, oh yeah, the U.S. isn't the superpower anymore, China has officially taken over, let's stop selling and buying and selling oil in U.S. dollars. Once they start using other currencies and it reaches a critical mass, then you're going to see the U.S. dollar is going to drop because it doesn't have anything artificially propping it up. You don't have the currency exchange happening every single day with billions and billions of dollars of oil being purchased in U.S. currency. So I'm I'm going to wrap it up there and just show you one more thing. This is the U.S. debt clock, $17 trillion. It has to crash. This is unsustainable. The U.S. markets cannot sustain with the U.S. national debt going up. $54,726 per citizen debt. It's unsustainable. I just wanted to give you some information here. Protect your assets. I do admit I was wrong in my last video. However, this is a market that's not acting rationally. And when you see this crash happen, when you see it come down and test these levels, I doubt it's going to, kind of hang around here long. It's probably going to come back down and meander for a while, and then I would say once the crash really starts to take effect, they're going to pound it right back down to these levels or more. So take care of yourselves, take care of your investments, and be smart. Don't just think the market's going to go up forever, because what goes up must come down. So thanks so much for watching. I'm not claiming to be some market prophet, but I do have some information that's worth listening to. I hope this has helped you get some more information about what the markets are doing and realize that it's not really always up, up, up. What goes up must come down. So protect yourself, take care of yourself. I love you, and have yourself a wonderful day.